Hey guys, Will Sebastian here, co-founder, co-mentor at The Trading Mentor. Don't forget you can join us underneath. We're just about to go live to our Zoom Academy live room, as we do every day for 2 or 3 hours, and cover CPI data. Could be a big one today, lots to go over, including some of the stuff I'm going to talk about now. So if you want that for free, underneath you can get our training and then you can proceed. So let's go ahead. High reward / low risk. Everyone is all about it, okay? Everyone who's looking to trade wants something that delivers returns with considerably low risk. And this really is something which we founded upon. We're not looking for smash and grab. By high reward, we're saying the amount of money you can make over time by taking low risks individually, managing your trading correctly. And this system, the strategy and everything that works within it relies on 3 main points, which I'll go into verbally by description. I'll show you on charts. So make sure you watch this all the way through, because I'm going to be doing some really in-depth training on those charts, particularly. So high reward, low risk. How are we going to manage that? How are we going to orchestrate our portfolio and our approach so that we're getting considerable gains over time without blowing out and going absolutely crazy, going nuts and chucking, too much out there for what we can really have, biting off more than we can chew, if you like. So this relies on 3 factors, and for me personally, it's what puts everything together. These are things I've taught people for years, as has my co-founder, co-mentor, Alex Sorrow. He's put them all in his training too, and uses them in his trading as well. First of which is probability understanding. Now, you've got to get into your mind, and again, like I said, watch this all the way because I'll show you on charts. The markets as a whole are just a series of probabilities, right? So every day when you've got candles printed across all time frames, they're just representing essentially where orders are going in and out. And when those orders are going in and out, and when that candle is printed with its wicks and its body open and close, it tells you probability. Because often where something has happened before, it's likely to happen again. So therefore you get some probability. Now, the reason for that is because when someone makes a deal at a price, that information that the market is telling you via that candle wick is saying that price is a preferred price for closing shorts, okay, and opening longs, or closing longs and opening shorts. Okay, so those prints are those order prints of where those decisions have been made effectively are what form the probability aspect. Because like I said, markets repeat because people make deals at the same prices. If you go out anywhere now and you think about something you want to buy, perhaps in a shop, and you see it at a good price, it's likely that when it comes back to that price, maybe it's a half price sale, you'd be more likely to buy it because you know that that price is low. You know it's a good price to buy, essentially. Markets are no different. Because when someone has bought somewhere before within a given time period, they'll see that price again, and investors will say, well, that's undervalued, therefore I'll get long and I'll look to get value on my up move, for example. Or perhaps they'll get short, borrow contracts, and on a fall, they will experience such gains and growth in their assets. So probability is what makes markets. You can call it order flow, you can call it supply and demand, call it what you like. But at the end of the day, all of that represents the probability of somebody, or be it an institution or an investor, buying at the same point or selling at the same point. So the second part, therefore, is, if you've labelled somewhere that is probable, how are you going to judge the size of your investment? Okay, and this is really where the low risk part comes in, if you like. Within our method and our strategy, we diversify and we take lots of small sizes. Now, that is considerably better than taking one asset and having a massive size, okay? Because if that one asset moves one way, you're just going to find that you're running a massively higher risk. Diversification as a strategy, just in general, in anything, is a natural risk management procedure. It's going to lower the risk overall. So anything you're trading at any point, or any portfolio you open as such, you're going to need to make sure that it's diverse. Because otherwise all your eggs are in one single basket. And that can incur a huge drawdown in a matter of moments. Perhaps if you get a sudden sentiment inflow or market bias or something that shocks into the markets. For example, like on gold now, if you were only trading gold and you were trading it at a massive size, there's a good chance you'd start to blow out soon because it's going up, 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 and up. And if you're short, expecting a fall and banking everything on that fall, and it's not happening, then that's a problem. Whereas you could be trading 10 currency pairs, 5 of them are going up, 5 are going down. It's not going to massively shock your drawdown. It's not going to put you in a big loss immediately. And like with our strategy, you'll be making profits on other assets to wash out any loss on the remaining assets in your portfolio. That's why we hedge for gains. So, with that, you have to proportionate your sizing to the probability of success. So if the level has a higher probability, you might consider a more reasonable size rather than just a small size. But you'll never go over a maximum size for any asset or for your whole portfolio. You've got to be really strict with the limits as to how far you're willing to expose yourself, like I said, on any asset or portfolio. And that's so important because if you can't do that, even if you diversify, if your sizes are too large across the board, then you'll find any reasonable move away from a price where you had it is going to be a shocker. It's going to cause a serious problem. So just be very careful with that. Now, number 3 as well, and we'll do a bit of sentiment bias reading today. You've got to understand really at the end of the day, what is moving price. Okay. So price in any market is ruled by the decisions of traders, like we know, the deals going in and out. But what drives those deals, again, is supply and demand off the back of market news or sentiment. Sentiment is basically the mood of the market. So if you've got strong positive market sentiment, you may see price rise. If you've got lots of fear in the market and negative sentiment, you may see the price of an asset fall. Now, the reason why it's so important to be in touch with that is because it helps you trade with the way the markets are going. If you completely ignore sentiment and you ignore news and you don't look at what's going on in the bigger picture, you'll find you start trading counter sentiment, which is okay. But if you don't know really how to proportionate your size, again, based on that changing probability, because remember, if the sentiment's against you, the probability of what's going on naturally changes. The probability of the markets naturally changes because you're fighting the wave of the mass market going along. Okay, so for example, if you've got a hawkish tone out the Fed, it's more likely that you'll see demand or inflows into the dollar. If you're shorting the dollar at the same time with massive sizes and ignoring the fact that everyone's buying it, you're going to find, again, your risk is high, therefore. So understanding at its core what moves markets and then tracking what moves markets as they go is going to stop you having that massive risk. It's going to stop you putting your risk out of proportion with reality and out of proportion with the way the markets are going. So these 3 things together rely on probability and the size of your investments at any time, okay? Because those 2 things are going to underpin whether you make money with a low risk, high reward over time, or you lose money because your risk is too high for the reality or the natural market flow that you're trying to trade. Because remember, markets trend continually. Over and over, perpetually on all time frames. Okay, 1, 5, 15 minute, hour, 4 hour, daily, weekly, monthly, yearly, all the way through they trend on different scales. Within that is various probabilities. Within that should have various sizes. And within that is various periods of changing market sentiment. So if you've got a trend on your lower time frames, it could be because the news has just come out. That is changing direction. Whereas for the whole time, you'd have strong news pushing the market up. So I'll give you an example of that particularly. We will load we'll go for E-mini futures via TradingView here. So what has pushed this market up essentially is the risk on market. If you look at beforehand, okay, on previous falls and previous rises, you can see little elements of probability feeding in. Okay, so for example, if you just cast your eyes over here, what can you see? Well, you can see short orders going out the market and long orders coming in the market. How do I know that? Because there's candle wick rejection. Then it becomes absolutely no coincidence whatsoever that when you go over here, you get a candle wick again. Okay, and then you get another candle wick in line with this, and then another candle wick in line with that. So what's happening all the time is the markets are repeating themselves. It's because of probability. The probability here, you can see, was long when you pulled down, because you'd previously had traders taking it long before. There's no other reason than that. That is pure market probability. Now, when you break that level and you come to the next one, again, you get the same thing. And you get the probability pulling you to the upside. And then the same thing happens here. Now, these are called flip zones, because the market is flipping between long and short, and deals are going in and out. So it's preferred and therefore has probability. So you can see that repeat. Now, it's likely that level, that same level, is going to repeat forever from now on. And it's the same for all markets. All markets have various levels of support and resistance that just repeat all the time. And they will form what is your probability bias. Okay, that's naturally what will occur. Over time, the more you see this printed, the more you will see that probability reflected entirely. And even so, on the absolute falls, like you got here, you can see across the board, if I just draw a horizontal line, various similar hits along this blue line of price action. That's why I called it long to my students, myself, and publicly. Okay, so probability, you can clearly see, lies there. Now, it's not just indexes where that occurs. I mean, you've got it on things like gold, for example. Okay, so if we just go for the weekly, again, you can call it what you want. You can call that supply if you want, but supply is just another word for where people shorted before and where the probability is. And that's why the market repeats and repeats until that area is broken. Okay? So you can see the market goes back to that point so many times until it breaks. Now, that's where the sizing comes in, because you would have to, and as I warned many of my traders, I said, be careful on your size, because the more you hit this level and the positive bias is going into gold, the more likely it is it's going to break. And once you got to this point, it absolutely broke. So if you were willing to short that, you would have to be very, very careful and understand perhaps it's best to short it lightly and keep all the gains you took previously. So therefore, mathematically, you can't be experiencing a larger drawdown swing. Okay? So even though you had a high stochastic oscillator, you've flown up now where you are. And what's carrying this is the sentiment bias. It's the positive inflows for gold at the moment. Okay? And then once you return to this area of support, it will become a flip zone. Okay? Because that will now be support. And it will be a very strong level, because you've got lots of probability there. You've got lots of hits right on the same area, as you can see. So once you return, that is where your level of probability will be. Okay, so now really what has to come into play is your sizing. Okay, so if we keep gold up, for example, you can see that the price has experienced, like I said, that very strong positive market flow or market sentiment. That's holding it up. Now, if you're willing to short this, you are going to get a value trade because the price is very high. Okay. But the key here is about sizing. So you've got two options, haven't you? You could say, okay, well, I want to short everything I've got. I want to sell everything I've got on gold and take a complete risk by trading only gold. Or you could take a minuscule size because you know the sentiment is against you. It's moving wildly against you. And then you could trade various other FX pairs, like Euro CAD, Euro New Zealand, Pound AUD, etc., 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 with small sizes as well. So what that does is it takes a completely different approach. Instead of gambling on this falling tomorrow with an enormous size, you take a small size here, and then you take a small size everywhere else. Okay? And that is so much better than taking these unsustainable risks, because at the end of the day, you can pretend it won't go higher all you want. I mean, I'm not saying it will for definite, but I'm saying it could. And if it does, it's going to absolutely screw you over. It could be existential for your portfolio. It could mean that ultimately you lose everything. And that's what happens to many traders. So if your size and your diversification was disproportionate to the overall risk of the market now, you're going to lose all your money trading a swing like this if you trade it short. Okay? Because if that market keeps going, especially with the pip size of gold, then you're going to get just absolutely trashed. And obviously you don't want that. So sentiment pushing against you, lessen the size. And look, there's no resistance to go off, so you're unawares of probability. So again, you'd lessen your size, trade lots of other things all at once. Okay, it works a lot better. Now, the third and final is, like we said, market sentiment. Now, it's a really good time to do this because we've got CPI soon, which I'm going to go and run the Zoom for. But currency pairs, particularly, for example, with market drivers, are dependent on the actions of central banks. So the decisions central banks make in terms of controlling or restricting or loosening the supply of money in economy is what moves currencies all the time. So, for example, if you had inflation data now and it looks sticky or it was high, the US or the Federal Reserve might say, well, we need to keep rates up to bring this down. We need to strangle the supply of money so people stop spending it. Okay? If they can't borrow it as easily, they can't spend it as easily, prices start to fall. That's the point. So if you saw that, you might get euro weakness against the dollar and pull you right down. Okay? Now, if you decided that as soon as it started to fall, you were going to flood in with long orders all along here, you wouldn't necessarily be wrong on your approach, but what would happen is your size might be disproportionate to the fact that there's actually really strong bias for the dollar, and therefore it's likely it's going to fall. You might be accumulating good probable deals at different respective price action levels, but what you'll notice is you'll get poor value buying early at first of all, but even though they are probability levels, you're going to be trading against a really harsh market sentiment, which is pulling you really quickly or indeed past those levels. So if your risk isn't right at that point for the market sentiment and the market driver, which could whack you down on improved dollar strength via a hawkish tone, then you're going to have serious problems. And your size is going to be disproportionate. So therefore, again, it's not going to be a low risk method. It's going to be a high risk method, even if you're buying at areas of probability like the ones labelled now. The sentiment will be pushing you into them so harshly and you won't deviate your risk. So you're going to have problems. Okay, so it's very important to understand at all times what is moving the market and be absolutely on the pulse when it does. We post that every single day in the Discord all day with our plans, and then we discuss in-depth macro, microeconomics and market sentiment within our live room continually every day as well, because we like to get traders to grips with where the markets are going and how, because the point is, once they understand the market drivers and the sentiment bias, they can begin to deviate their risk so it suits that fixture or that method of a low risk, high reward over time, the keywords over time approach. So really, in essence, those three things, probability, risk management in terms of sizing and diversification, and what's actually pulling the markets at the end of the day are what are going to form the basis for controlling your trading. Okay, having a controlled risk bias, having a carefully coordinated and planned portfolio that delivers consistent gains without you going way over the top in terms of risk. So I hope that all makes sense. Of course, if it doesn't, chuck it in the comments. Don't forget to like, share, comment, subscribe. And if you do want to start free underneath or indeed join our trading room, it's all under the video. Go and get it. We're going to go live on Zoom shortly. See you soon.